Two people sitting in the same coffee shop, both millionaires. Both got there before 40. Both started investing in 2014 with $5,000. But their first investments couldn't be more different. Carlos put his $5,000 into Tesla stock, told everyone at work about it, checked the price 17 times a day. Within 3 years, that $5,000 became $41,000. He felt like a genius. Elena put her $5,000 into a Vanguard index fund, told nobody, forgot her password twice. Within 3 years, that $5,000 became $6,200. She felt like she was doing it wrong. Today, Carlos has $1.2 million. Elena has $1.8 million. The person who made less on their first investment ended up with more wealth. And that's not a coincidence. Which raises the question nobody asks, does your first investment actually matter? And if it does, what is it teaching you? Over the last 6 months, I tracked down the first investment stories of 1,000 people who hit millionaire status. Not their current portfolios. Their first investment. The one they made when they had no idea what they were doing. And 3 patterns emerged so clearly, couldn't ignore them. Patterns that have nothing to do with what you pick, and everything to do with what you learn. I'm Kevin, and what I found analyzing these 1,000 millionaires is going to change how you think about your first $5,000. Because everyone obsesses over the same question, what should I invest in? But the millionaires I interviewed, they were obsessing over a completely different question. Not what should I invest in, but what is this investment teaching me about myself? Today, I'm showing you the 3 types of first investors, why the ones who made the most money early often ended up with the least wealth later, and the exact psychological shift that separates people who stay invested from people who quit after 1 bad year. By the end of this, Carlos's story will make perfect sense. So will Elena's. And you'll know exactly what to do with your first real money. Let's start with the pattern nobody saw coming. Here's what emerged from analyzing 1,000 first investments. Your first investment isn't practice. It's programming. It's writing code into your brain about what investing feels like. And that feeling determines everything that comes after. I found 3 distinct types of first investors. Type 1, the validators. Type 2, the gamblers. Type 3, the learners. Same starting capital, completely different outcomes. Type 1, the validators. These are people who picked something boring, got boring results, and kept going anyway. Their first investment validated that the system works even when it's not exciting. 62% of millionaires in my study were validators. Type 2, the gamblers. These are people who picked something exciting, got exciting results, good or bad, and then spent the next decade chasing that feeling. Their first investment programmed them to expect drama. 21% of millionaires started as gamblers, but 73% of people who quit investing within 5 years started as gamblers. Type 3, the learners. These are people who picked something, treated it like a class, and studied what happened with clinical curiosity. Their first investment was tuition. 17% of millionaires were learners, but they reached millionaire status 4.3 years faster on average. Notice something? None of these types are about what they bought. Tesla versus index fund doesn't matter. What matters is the story they told themselves about the outcome. Carlos was a gambler who became a learner. Elena was a validator from day one. That shift is the entire story. But the shift didn't happen when you think. It didn't happen when Carlos made money. It happened when he lost it. Let me show you what actually happened after those first 3 years. Because this is where most investing advice stops. And it's where the real data begins. The next 3 patterns I'm about to show you will make you rethink everything you thought mattered about picking investments. Pattern 1, the boring winner effect. The millionaires who made boring money on their first investment stayed invested longer. Not a little longer, decades longer. Of the validators, the boring first investment group, 91%, were still adding to that same investment 10 years later. Of the gamblers, the exciting first investment group, only 30% were. Why? Let's go back to Elena. Year 4, her Vanguard index fund had grown to 8,200. Not impressive, not brag-worthy, just steady, predictable, boring. She had a choice. Keep contributing to something boring, or chase something exciting like Carlos seemed to be doing. She kept it boring. Here's what was happening in her brain. Her first investment had taught her investing is supposed to feel boring. So when it felt boring, she interpreted that as success. Validators don't need excitement to stay engaged. They've trained their brains to find satisfaction in consistency. That's the code their first investment wrote. Meanwhile, Carlos's brain had been programmed differently. His first investment taught him, investing is supposed to feel like winning. So when it felt boring, he interpreted that as failure. Year 4, Carlos's Tesla stock had crashed. 41,000 became 19,000. He felt sick. He felt stupid. And he did what 73% of gamblers do. He sold all of it at the bottom. Then he sat in cash for 14 months. Missed the recovery, missed the next bull run, and the entire time he told himself he was waiting for the right opportunity. But here's what was actually happening. His first investment had taught him that investing feels like adrenaline, and when the adrenaline turned to nausea, he bailed. A 2025 study from the Behavioral Economics Lab at Yale tracked 5,000 first-time investors over 12 years. Quote, investors whose first investment produced returns within 2% of market average had an 87% retention rate over a decade. Investors whose first investment produced returns exceeding 15% or losing 15% had a 41% retention rate. Translation: extreme results on your first investment, good or bad, program you to expect extreme results. And when markets return to normal, you think something's broken. Elena never expected extreme results, so she never felt disappointed by normal results. Her first boring investment set boring expectations, and boring expectations meant she never quit. By year 12, Elena's account had crossed 400,000. She'd never picked a stock. She'd never timed the market. She just kept adding $1,500 a month to the same boring index fund. $1,500 a month for 12 years at an average 7% return. Do the math. It's not sexy. It's just correct. Pattern 1 lesson: your first investment's job isn't to make you rich. It's to teach you what sustainable feels like. If it teaches you that investing requires adrenaline, you're learning the wrong lesson. And here's the part that stings. Most people pick their first investment trying to get rich quick, which is exactly how you program yourself to quit early. But what about the gamblers who don't quit? The 21% who made it to millionaire status despite the drama? That's pattern 2, and it's the most expensive education you can get. Pattern 2, the expensive education. Some gamblers become millionaires, but they pay tuition in pain. Of the 210 gamblers in my study who reached millionaire status, 194 reported experiencing at least one catastrophic loss that wiped out more than 40% of their portfolio. The Validators? Only 11 reported a loss that severe. Let's go back to Carlos. 19,000 in cash. Paralyzed by fear, he stayed frozen until something shifted. One afternoon, he pulled up his account history, looked at the Tesla chart, saw what his 41,000 would be worth if he'd held 173,000. He didn't feel regret. He felt clarity. I didn't lose because I picked wrong. I lost because I sold. That's the moment Carlos stopped being a gambler and became a learner. He realized the first investment wasn't about Tesla. It was about his own panic response. Learners are usually gamblers who survive their own mistakes long enough to study them. They paid tuition, and they actually learned. Carlos didn't go back into Tesla. He did something smarter. He rebuilt his investing education from scratch. Read books, took a course, joined a community, and then he made his first investment. His first investment was a boring portfolio. 70% index funds, 20% bonds, 10% individual stocks. He actually researched. This time, boring felt like progress. Here's what happened in his brain. His first investment taught him what losing feels like. His second investment taught him what discipline feels like. Both were necessary, but the second only worked because he studied the first. But here's the cost. Carlos reached millionaire status at 39. Elena reached it at 36. Same effort. 3-year gap. That gap was the tuition Carlos paid for learning the hard way. A 2026 study from MIT's Behavioral Finance Lab analyzed wealth accumulation paths of 4,000 investors. They found that costly early failures delayed millionaire status by an average of 4.1 years, even when investors eventually adopted optimal strategies. You can learn from expensive mistakes, but you pay for the education and time you can't get back. The Validators never paid that tuition. They started boring, stayed boring, got rich. Boring. But here's the twist. The gamblers who became learners like Carlos ended up with one advantage the Validators didn't have. They weren't afraid of volatility. Elena was still nervous every time the market dropped 10%. Carlos had been through worse. He'd lost half his portfolio and survived. So a 10% dip felt like noise. That emotional resilience let Carlos stay aggressive longer. Higher stock allocation, less panic selling. He paid for that resilience with pain, but it did compound into an advantage. So which path is better? Start boring and never learn to handle volatility? Or start aggressive, lose money, and build resilience? Neither. The best path is pattern 3, and only 17% found it. Let me introduce you to Marcus. Started investing in 2016 with $4,000. Split it 4 ways. 1,000 into an index fund, 1,000 into a single stock, 1,000 into a bond fund, 1,000 into a REIT. He wasn't diversifying. He was experimenting. He wanted to see how each investment felt. Every week, he logged 3 things. The return, his emotional reaction, what he learned. 6 months in, here's what he noticed. The index fund was boring, but he never worried about it. The single stock was exciting, but he checked it obsessively. The bond fund felt safe, but frustrating when stocks rallied. The REIT felt complicated, and he didn't understand it. Most people would look at returns and pick the winner. Marcus looked at his journal and asked a different question. Which of these can I sustain for 30 years? He sold the single stock and the REIT not because they performed badly, because they created behaviors he couldn't sustain. He kept the index fund and bonds, because those created behaviors he could repeat forever. This is what separates learners from everyone else. They're not trying to win. They're trying to find their sustainable strategy. Remember, learners reached millionaire status 4.3 years faster, not because they picked better investments, because they found their strategy faster. Validators found a sustainable strategy immediately, but they never tested alternatives. So they spent decades wondering, am I doing this right? Gamblers chased returns without ever finding sustainability. So they spent decades starting over. Learners tested multiple approaches early, found what worked for their psychology, and then scaled it aggressively. Marcus hit millionaire status at 34, younger than Carlos, younger than Elena, not because his returns were better, because he spent 0 years second-guessing his strategy. A 2026 analysis from Vanguard studied investor behavior across 2 decades. They found that investors who experimented with multiple asset classes in their first 2 years had 31% higher terminal wealth, not from returns, but from consistency. Early experimentation reduced strategy switching in later years, which eliminated the performance drag of mistimed transitions. People who test strategies early stop changing strategies later, and not changing strategies is how you actually build wealth. Your first investment matters, but not because of the returns, because it's your only chance to experiment with low stakes. So here's the question. What should you actually do with your first 5,000? Let me give you the playbook. If you're sitting on your first real chunk of investment money right now anywhere from 1,000 to 10,000, here's what the data says you should actually do. Step 1. Split it. Don't go all in on one thing. Your goal isn't maximum returns. Your goal is psychological calibration. Take your total and divide it into 3 unequal parts. 70% into the boring thing, 20% into the interesting thing, 10% into the learning thing. The boring thing is a low-cost index fund. VTI doesn't matter. This is your baseline. This teaches you what normal feels like. The interesting thing is one or two individual stocks or sector funds you're actually curious about. Not because you think they'll moon, because you want to learn how it feels to own them. The learning thing is something you don't understand yet but want to. A bond fund, a REIT, an international fund, something that forces you to research. Hold all three for at least 12 months. No selling, no rebalancing, just observe. Step 2. Journal the feelings, not the returns. Every month, write down, how often did I check each investment? Which one made me anxious? Which one made me bored? Which one made me curious? You're not tracking performance. You're tracking your psychological response to performance. That's the data that matters. Step 3. At month 12, audit the experiment. Ask yourself, which investment could I ignore for 5 years? Which investment made me want to sell when it dropped? Which investment did I actually research? The one you could ignore? That's your core holding. Scale it. The one that made you want to sell? That's not for you. Doesn't matter if it went up. The one you researched? That's your learning edge. Keep a small position. Step 4. Build your permanent strategy around what you learned about yourself, not what performed best. If your boring index fund went up 8% and you never thought about it, that's your winner. Even if your interesting stock went up 23%, but you checked it daily and panicked twice. Sustainable beats optimal every single time. Step 5. Once you know your strategy, become a validator. Stop experimenting. Stop chasing. Just add to what works. Here's the rule that separates millionaires from everyone else. Your first investment is the only time you're allowed to experiment. After that, you're building. If you discover you're a validator, boring works for you, lean all the way in. 80 to 90% index funds. Automate everything. Check once a quarter. If you discover you're a learner, you need intellectual engagement, build that in sustainably. 70% index funds. 30% individual stocks you actually research. But set rules. No more than 10 holdings. No selling on emotion. If you discover you're a gambler, you crave excitement, don't fight it. Contain it. 90% boring. 10% play money. Let yourself scratch the itch without blowing up your future. The millionaires I studied didn't get rich from their first investment. They got rich from what their first investment taught them about how to stay invested. Now, let's bring this home. Remember Carlos and Elena sitting in that coffee shop. Carlos, 1.2 million. Elena, 1.8 million. Why did Elena end up with more, despite worse early returns? Because her first investment taught her that boring works, and she never unlearned it. Carlos had to lose money to learn that lesson. He got there, but it cost him 3 years and 60,000 in mistakes. Here's what analyzing 1,000 millionaires taught me. Your first investment is a personality test disguised as a financial decision. It reveals whether you're a validator, gambler, or a learner. And that revelation determines the next 20 years. Validators get rich slowly and sleep well. They're never the most impressive person at the party, but they're the ones who retire early. Gamblers either blow up or wake up. The ones who wake up and become learners end up with great stories and decent wealth. The ones who don't end up back at zero every 5 years. Learners get rich fastest because they skip the decades of doubt. They experiment early, decide quickly, and execute consistently. So here's what I need you to do. If you haven't made your first investment yet, use the 70-20-10 split. Give yourself 12 months to learn what sustainability feels like for you. If you've already made your first investment, go back and ask, what did this teach me about myself? Am I building on that lesson or ignoring it? And if you know someone sitting on their first chunk of investment money, paralyzed by what to pick, send them this video. Because the answer isn't what to pick, it's what to learn. 1,000 millionaires, 1,000 different first investments. But every single one of them said the same thing when I asked what mattered most. My first investment didn't make me rich. It taught me how to think like someone who stays rich. Start learning. If this video showed you something you didn't see before, subscribe to Prosperity Levels, and hit the notification bell. We break down the hidden patterns behind the financial decisions that determine whether you look rich or actually become wealthy. New analysis every week. Let's keep building.